Market insiders are at the ready. J.J. Kinahan, Chief Derivative Strategist at Thinkorswim, joins us, as does Adam Bold, founder and CEO of the Mutual Fund Store. Welcome, guys. Nice to see you. Adam, I'll start with you. I mean, which is it? A lot of people do expect this market to head higher as we go into the end of the year. One would think this is kind of the pause that refreshes.
Yeah, absolutely. I think that this is really a healthy thing to have happen in the market because it introduces some fear back into the market, which is not a bad thing. And also it gives people who have been waiting for an opportunity to get in that opportunity. Remember, we've still got $4 trillion that's sitting on the sidelines. That number should really be more like $2 trillion. So I think there's a lot of opportunity going forward.
JJ, are we in a correction? And if so, how much more have we got to go?
I don't think we're actually in a correction. So, Michelle, I'm sorry. We had a nice rally. I think people are taking some profits. I think what you're actually seeing, more importantly, is maybe a rollover. The Dow has been significantly stronger than the NASDAQ over the last few sessions. So I think people may be moving their money from some of the tech sectors into some of the more old line type businesses, shall we say, that are listed on the Dow. That's the only real thing I see. I don't necessarily see a big sell-off here. As the guys just mentioned, I think it's healthy that we're seeing a little bit of a sell-off here, people taking some profits, reassessing where they're at.
At some point, I mean, we've had a pretty good year for the stock market when
Absolutely.
all is said and done, from the March 9 lows to where we sit today. And you would think, Adam, at some point that somebody's going to want to start thinking about taking some profits for tax purposes before the end of the year, or at least locking in those profits, don't you?
Yeah, but Bill, remember that this market was down a lot for two reasons. The first was the recession. The second was that a year ago we were facing a global financial meltdown. And now I think what's happened is that global financial meltdown is off the table. So I think the market is probably where it would have been if we had just had a recession. And while we are up a lot from the lows, remember the Dow was 14,000, we're just under 10,000 now.
But you know how market psychology works. As soon as you're made whole again, you want to get out. I mean, I'm thrilled that I'm getting a profit right now, don't you think?
Yeah, and one thing I would disagree a little bit with is the fact, earlier you mentioned money being on the sideline, so to speak. There's a reason that money's on the sidelines. It goes to what we're talking about, market psychology. When, a 10-year rate is trading around 3.5,
right,
there's a reason that it's so low. People want to be safe still. I still believe that it's going to take us another 6 to 18 months for us to say that there's no, we may all believe there's no possibility of an economic meltdown, but on Main Street, I don't think they do.
The fear of that second dip, the double dip thing, is the thing that our latest boogeyman, right?
Every time the market goes down a little bit, people think it's going to go down a lot. But at some point, we're going to get to the greed factor where people go, I'm afraid I'm going to miss out on the next run in the market. And, of course, instead of buying at 6,500, they're going to buy at 11,000 or 12,000.
Yeah. We'd have to forget our pain for that to happen. But all right, thanks very much, gentlemen. Appreciate you being here.